Today, I found a high growth stock with plenty of future potential. In the last 5 years, it's seen revenue and free cash flow grow by over 80%, with increasing profits of 132%. So what is the catch with this stock? Is it simply too expensive? Well, it is trading at a significant premium to the UK market average of 10.7 times. With a current price to earnings ratio of 34.9 times, it is closer to the 52-week high than its 52-week low. That said, historically it has traded at a much greater premium, suggesting that investors have either become more bearish on the future growth of the company, or the business's growth has outpaced investor sentiment. Although trading near its 52-week high, a look at the price to free cash flow ratio shows a much more reasonable valuation. The price to free cash flow of 20.7 times is in line with the 10-year average and is considerably lower than its 5-year average, perhaps suggesting that investors are focused more on free cash flow as opposed to profit growth, given that the market capitalization has increased at the same pace as the free cash flow. But can this free cash flow growth really continue? 2023 disagrees, as free cash flow has fallen by 3% in the last year. This has been driven by a stagnant operating cash flow due to an increase in stock-based compensation and a reduction of other cash from operations. I find it also slightly amusing that the company has issued 4.9% more shares in the year, and this has led to a total increase in the shares of 11% in the last 5 years. This could suggest that the management aren't aligned with shareholders and could be a major red flag. On the other hand, this is an increasingly profitable company with a return on capital employed of 24%, and it has seen its earnings per share improve by 129% in the last 5 years. So maybe shareholders are willing to overlook this small slip up, but what about the quality of the balance sheet? First impressions indicate a very strong balance sheet, with minimal debt and increasing levels of equity by 83% and cash by 183%. This has fueled an increase in the net book value by 115% in the last 5 years, meaning there is a subdued debt to equity ratio of 4.1%. And in times of financial trouble, this business can quite easily pay off its short-term debts. So what's wrong with the balance sheet, and why might this be disastrous for future returns? Well, digging deeper into the accounts, we can see that in October, they announced a new revolving credit facility of up to 280 million euros. Perhaps they're being financially responsible by having this debt available if they need it in a pinch. The problem is that they've announced a potential acquisition. This acquisition is still subject to regulatory approval, but it has been stated that this facility will be used to help fund it. Now, there are some positives in this. Firstly, it is a rarer opportunity. This is because the former owner of this business has been forced to divest this business as part of its own ongoing merger. And so it's understandable why the business might have rushed to secure debt in order to make this acquisition work. There's also strong synergies between the two companies, with not only a cultural alignment but expectations of enhancing the earnings per share by mid-teen figures. It also extends the geographical reach of the company and means it can add further value to its US offering. That said, when was the last time you heard of a planned acquisition that wouldn't benefit a company? So, what is the problem with this acquisition, and why am I so concerned? Well, the debt at current rates is going to be at a high interest rate, but that's not the main concern. The business cash flow is positive, that's good, but when we consider the combined cash flows of this new business plus the old business and look purely at the debt that's going to be added to the balance sheet, it would take 4 years to pay off this purchase, which in my books is fairly risky. Sure, this business has had a consistent track record of delivering growth, but if an unknown factor were to impact the business model, they are no longer as well positioned to deal with it. However, for dividend investors, it was stated that the progressive dividend policy is expected to remain unchanged following the acquisition. Whilst the payout ratio of 22.7% is rather low and realistically is not a large drag on the free cash flow of the business, this is still yet another factor that hasn't been considered, especially when this business has grown its dividend by a remarkable compound annual growth rate of 21.5% in the last 10 years, can they really maintain this level of dividend growth, or will it slow down? Given that the current yield is 0.85%, I suspect that current investors really aren't that bothered about the income from this stock. But what do I think of this stock? Is it an opportunity to buy? There's no denying the quality of this business. It's got a quality score of 96.3%, which positions it in the upper echelons of the UK markets. However, it misses the bar almost astronomically when it comes to valuation. Even with an optimistic future earnings growth of 14% annually for the next 5 years, a discounted cash flow model would give out a fair price of £7.13 per share, a discount of 31% from the current share price of YouGov. Perhaps this stock is just too expensive for you. Do I know of another cheap but growing stock? Well, yeah, click here to learn about this really cheap stock.